Heavy is the head that has to manage all of this.
Hey everyone, welcome back to my channel.
We're now incentivized to buy what we already buy.
Fumbling through college had me building.
I also got some done on the other side.
And that was right around, I would say, May, maybe right before renewing the lease for this property.
Welcome to the channel, Martha.
Thank you for having me here.
Oh, I was going to say, I am getting up there in age, I'll tell you what.
Bills paid by other people, life was never this good. I had to step back, knowing that it's...
Hey everyone, welcome back to my channel. So this topic is the topic. This is something that I'm probably going to hit on very hard today, and it is about the best future long-term investment plan. Now, this is a topic that's been highly searched, and I'm going to hit this one hard. A lot of people have conflicting views on what is the best long-term investment strategy, and I'm going to tell you in about 20 minutes or less how I have successfully done my long-term investment strategy. This channel is literally called Investing for the Future. So I am absolutely going to knock this one out of the park. Subscribe to the channel and stay tuned for all of the amazing things that is going to be said throughout this video. Now, you know, I started in the stock market. Easiest gateway to entry. You can easily start to dissect and understand the stocks. There are going to be some high-level terms that I use in this video. So if you do not know what those are, you want to pause the video and Google it if I don't go over it within the video, okay? I'm going to try to make this short and quick. I am a growth dividend stock investor. What does that mean? That means I invest in dividend stocks that grow in value over time. That means they don't decrease in value and they still offer me a dividend. And typically they will grow that dividend as well over time. That's why I like ETFs, which are exchange traded funds, similar to NOBL, which is a dividend ETF based off of dividend aristocrats. Dividend aristocrats are just companies that have paid a dividend for over 25 years and have grown that dividend over time and are typically blue chip companies. What is a blue chip company? A blue chip company is a company that is a big, well-known top 500 company, has been around for a long time and has showed good results, right? When you say blue collar worker, those are people who typically work for blue chip companies. A blue chip company is going to be something like a Chase Bank or a Google or a Amazon, right? These are some blue chip companies, a Microsoft, that you are easily able to identify and understand and know why they're doing so well, right? Now, high level thinking, we're going to go straight into it. You all know my history and my background with the stock market, which has also helped me with my real estate endeavors, because the first time I pulled money out of my stock market, I added that to my savings and I bought my first real property, my primary residence. I was only there for a month, and so I just call it a rental property. And then I went ahead and I bought another property about 10 months later, but all with savings from investing in the real estate while I was still investing in the stock market, right? So now, after I bought my first rental property, I stopped using my stock market funds to invest in real estate, and I started using my savings as well as my passive income from the tenant paying me to now pay for more real estate. So the key to all of this is having discipline and the ability to save money as well as invest while saving money. In order to do that, you must be out of debt. A lot of people have a lot of car notes, car loans, phone bills that are reoccurring. And what I mean by phone bills that are reoccurring, I mean you still have a payment on your phone. Like, you can't expect to be the best of the best investing long term in your future and you have silly bills like that lingering around. We do not need to be paying $200 in phone bills, period. There's a lot more work to be done in your financial journey for your financial future that to be wasting $200. I still pay to this day $40 a month for my phone bill. So moving on along, after investing in this real estate, I started to get a passive income about $400 to $700 a month. right? Adding that to my savings, I was probably saving about $1,000 to $1,500 a month. All right. After a 10-month period of time, you generated enough money from both of these things to now put into another property. Call that your primary residence. What did I do? I started to house hack. House hacking is a strategy where you rent by the room. So I was living in one room, renting out the others. That was alleviating my mortgage, allowing me to keep my income, invest and save more aggressively, right? So now I have the rental property. Now I'm house hacking. Now I also have my stock market accounts, and I have little to no overhead costs. With that being said, that is the short-term goals being met, right? But this is a long-term video, long-term thinking. So what are you going to do in order to keep up and spur more growth, right? So the thing is, you're going to want to either get more rental properties, or you're going to want to maximize your stock tremendously. So this requires you to either understand your markets in terms of real estate or understand your markets in terms of stocks. Now, I will say it is easier in the stock market because you don't necessarily have to understand everything about stocks in order to be great within the market. You can just invest in ETFs. Now, the thing about ETFs is that they do have some expense to them. There is an expense ratio. You must understand what that expense ratio is to determine how much money are you willing to give throughout the rest of your life to this exchange traded fund. And these exchange traded funds are public. So you can actually just buy all the individual stocks within that exchange traded fund and not pay the expense ratio fee for that fund. Let me give you an example. NOBL, right, is a dividend aristocrat, as we talked about before. They're going to house certain companies like O. Realty O is a big real estate company, right? And actually, Realty O is another ETF, so pardon me for that. But Disney used to be in NOBL. I'll use a company that's no longer with them. Disney used to pay a dividend. You could buy Disney individually and not have to pay the expense ratio. But if you buy NOBL, you'll have Disney within that portfolio, but you now have an expense ratio along with that. You could have easily have just bought the Disney stock and foregone the expense ratio. But the thing about these ETFs is that it allows you to not think about these companies as much. It allows you to diversify yourself more so you're not truly exposed to the markets themselves. And it also allows you to really just put your mind at ease knowing that these companies are top tiers, or these ETFs are top tiers. They're doing all the evaluations and assessments for you so that you don't have to do all of the legwork. An ETF that is very notable would be the S&P 500 and VOO, which is the Vanguard version of the S&P 500. What these companies do is what these ETFs do is they buy the top 500 companies in the United States, and they end up putting it within one portfolio for you. And the expense ratio really isn't that bad on the S&P 500 as well as VOO. With that being said, it now allows you to hold the top 500 companies in the entire United States of America. Now, if one company is doing bad, people are probably going to invest in another company within the top 500. So what does that mean? Even when people sell, you will still gain because the money comes right back into the pot. And as people are compounding their gains, or dollar cost averaging, or becoming 18 and starting to invest in the stock market, they're just putting money on top of your money, making you richer as time goes on, right? Because a lot of people's retirements are 401ks and Roth IRAs, and I can guarantee you that a lot of their money is going to be tied to the S&P 500 and VOO. So if you're invested in that, you have a high likelihood of retiring very, very plush as long as you put in a right amount for you. Dave Ramsey states that you should put in 15% regardless of company and employer match. I say you can put in 14%, so not much of a difference between Dave Ramsey and anyone else. The city, in most cities, will tell you 10% is A-okay. And so, I would just say no less than 10%, period. I suggest 14%. Dave, again, suggests 15%. And most investors will probably suggest 15%. So start where you're at, continue to build on these habits. And I will tell you that the greatest investment that I made was to house hack early on, which means I had to save and invest, put that money together, and then throw that into a home where I was then able to house hack that, because the appreciation, the principal pay down, the ability to live with almost no expenses outside of utility costs and maintenance repairs, and then already having an income stream from working and other rentals that contribute to me just being able to accelerate my life, accelerate my savings, accelerate my investments, accelerate everything else now that you're no longer worried about shelter costs, right? Now, you can easily do this with a rental home or a rental apartment as well. The only thing is you won't have the appreciation and you won't have the principal pay down, and you won't have the negative side, which is the maintenance costs and repairs, right? So you can absolutely do that with an apartment as well, and yield similar results, but having a home gives you that added benefit that I just spoke about, which again is a tremendous, tremendous asset to you, as it's now growing your net worth and it is growing your ability to be more financially independent and free. So overall, I would suggest, if you don't have a family, to absolutely save and invest. Start with the stock market, but save a separate pile to buy a primary residence, house hack, so that you can then grow a even bigger nest egg over a 3 to 10 year period. Now, there are people who are extreme and will go 10 years. For me, I might go 5 or 6. And there are people who are on the lesser side and may only do 1 to 3 years or none at all. Regardless, figure out what works for you. I'm just telling you what the best long-term investment strategy truly is and what I believe it is, because I have seen the results. I've seen the results of being able to take my entire paycheck and use it as a savings or an investment tool to truly uplift my life in a matter of months, right? So again, this is the best investment strategy based on what I have known. I am not your financial advisor. I'm just an average guy on YouTube giving my life experiences. If you like this video, make sure you leave a like, comment, and subscribe to the channel. You know I post every single day at 8 a.m. daily on YouTube and on Rumble, and I can't wait to see you on the next one. Peace.